Today on Open Exam Prep, we're covering a topic for the Securities Industry Essentials exam, or SIE exam. We will be dissecting the structure and pricing of mutual funds, a cornerstone concept you are guaranteed to see on your test. Let's start with the basic structure. A mutual fund is technically an open-end investment company. The term open-end is critical. It means the fund can continuously issue new shares to the public and stands ready to redeem or buy back its existing shares at any time. This is different from a stock or a closed-end fund, which has a fixed number of shares that trade between investors on a secondary market like the New York Stock Exchange. With a mutual fund, you don't buy it from another investor. You buy it directly from the fund itself. And when you sell it right back to the fund. The price of a mutual fund share is based on its net asset value, or NAV. The exam will absolutely expect you to know how this is calculated. The formula is the fund's total assets minus its total liabilities, all divided by the number of shares outstanding. Imagine a fund holds a portfolio of stocks and bonds worth $100 million. It also has $5 million in liabilities, which could be expenses like management fees or advisory fees. If that fund has 10 million shares outstanding, its NAV would be $95 million divided by 10 million shares, which equals $9.50 per share. This calculation isn't done in real time. It's only calculated once per day, typically at the close of the U.S. stock market, which is 4 p.m. Eastern Time. This leads us to one of the most tested concepts, forward pricing. Since the NAV is only calculated once at the end of the day, any order to buy or sell shares during the day will be executed at the next calculated NAV. You don't get the price from when you place the order. For example, if you decide to buy shares in a mutual fund at 10:30 in the morning, your order is received, but the price you will pay is unknown at that moment. The fund will wait until 4 p.m., calculate its new NAV for the day, and you will purchase your shares at that price. The same is true for selling. If you place a redemption order at 2 p.m., you will receive the 4 p.m. NAV for your shares. A common exam trap is to present a scenario where the NAV is quoted midday and ask what price an investor receives. The answer is always the next one calculated at market close. So, how do the actual buy and sell prices work? When an investor buys shares, they pay the public offering price, or POP. The POP is the net asset value plus any applicable sales charge or load. So if the NAV is $9.50 and there's a 50-cent sales charge, the POP would be $10. Investors buy at the POP. When they sell or redeem their shares, they do so at the NAV. They receive the net asset value per share directly from the fund. Here's a simple phrase to help you remember the transaction flow. You pay the POP to get in, and you get the NAV to get out. For forward pricing, remember that you always look forward to the end of the day for your mutual fund price. Don't fall for the trap of thinking you can lock in a price midday. The SIE exam wants to ensure you know that all investors, whether buying or selling, receive the same end-of-day price, making it fair and orderly for everyone involved.